Ask Abby, providing answers, insights, and education designed to give you the tools and knowledge you need to thrive financially and live confidently in retirement.
And welcome back to another edition of Ask Abby with Abby Reed of the retirement family at Reed Financial Group. Now, Abby, in a recent episode of the program, we talked about the direction our money is moving and how that compounds the effects of the direction the market itself is moving, whether it's up, down, sideways, money's going in or just in a holding pattern or coming out. Sequence of returns risk, the order in which that happens, is a big deal for retirement longevity and the sustainability of our income producing power. Now, we've got some real world examples to put to this with kind of a surprising result when we look at it, following an income generation model that has been followed by Wall Street and the financial industry for about 30 years.
Yeah, so what we're going to look at today is the effect of volatility. So we've talked a lot on this program about sequence of returns risk and how that can affect an overall income plan and retirement. So today we're going to drill down on a real world example of two different types of strategies, two different types of funds, and the volatility that those have had over a 20-year period and the actual effect that that would have on the longevity of a retirement income plan.
So we're going to use a couple different indices as our benchmarks. One is maybe the most well-known indicator of overall stock market health, which is the S&P 500, 500 of America's largest companies, and one that is basically a daily reminder on all the news channels of how the stock market overall is doing, right? And then we're going to compare it to another index that is maybe a little less volatile.
So, right, the S&P 500 is probably the most popular index. When people talk about the market, typically they're really talking about the S&P 500. There's a lot more to the market, but it's not talked about as much. Most people are most familiar with the S&P 500. It's obviously the top 500 U.S. companies. And so those are the big names. Those are the ones that are always in the news and people are most familiar with. The other index that we're going to use or talk about today is the U.S. Aggregate Bond Fund, which is a ticker symbol of AGG. So you can go and look these up on Yahoo Finance or wherever. And you can actually look at these same things yourself if you want to do this exercise at home. But we're going to look at the overall return for both of these from a 20-year period and how the volatility difference. So with the S&P 500, a lot of times people think that the ride is much smoother in the S&P 500 than it actually is in real life. And that's because a lot of times we talk about average rate of return. So it used to be people were expecting about 7% average rate of return from the S&P 500. Now it's really quoted at more like 10%. But that doesn't tell the whole story. So there's big ups and there's big downs, and then there's the average there. But it's a volatile index. It is a compromise of individual stocks, which can have really large swings. It is diversified over those 500, so maybe not as volatile as just sticking everything in one stock, but it's still stocks, and they are volatile, like we saw last year and even in 2020 during COVID. The bond fund is going to be a little bit smoother. So it's not totally principal protected. So there can be some losses, but it's a much smoother ride. So with that, less volatility, you're going to have lower expected returns. That's just how it works. So the S&P has higher expected returns. The bond fund has lower expected returns. And so a lot of times people think, well, obviously, I want to go with the fund that has the higher expected return. But what we're going to talk about today is how that can be misleading and counterintuitive, especially when you're taking that income out of the portfolio. Really, what matters most is controlling volatility and managing the downside. Because when you don't manage that downside, when you have large losses and you're also taking money from that, the average rate of return matters very little, actually. And that's the scenario that we're going to talk about today.
Yeah, and I think that the results from this really were quite surprising, but it absolutely confirms what we have been talking about on the last episode with sequence of returns risk. This is a real life example, not an endorsement or recommendation in any way for either of these two funds or examples or indices, but using them as an example with their real world returns. Abby, from 1999 through a 20-year period ending 2019, the S&P 500 had a higher average rate of return, but it also had more volatility along the way. And when we put income on top of that volatility, when we are taking cash flow from our portfolio, it made a substantial difference in our end results.
Exactly. So with that time period that we looked at, the S&P 500 had an average return of about 6.5%, 6.48% to be specific. We started with $1 million and took out $40,000, adjusted it for inflation. So that's a starting withdrawal rate of about 4%, which a lot of times people, even financial planners, will say you're safe. You can take out 4% and you have a really good chance of not running out of money. However, in this example, in 2019, you're left with just about 150,000. So it went from $1 million to 150,000 in a period of time where the stock market was actually quite good. But there were periods of volatility like we can expect. And so that volatility is the cause of that principal balance being reduced. And eventually this person's going to run out of money, unfortunately.
I wonder in my own retirement, Abby, when I'm going to be comfortable seeing half of my starting balance or a quarter of my starting, in this case, 15% of the starting balance 20 years into retirement. I don't think that there is a time where I'm going to say, I'm only left with half, but I still feel comfortable for the rest of retirement, even deep into those retirement years. So in contrast, we then substitute out the S&P 500 for this less volatile aggregate bond index fund. What does this show us?
So in the same time period, this fund, specifically AGG, had an average rate of return of just over 5%, 5.04% to be specific. So that's a difference of 1.44%. So it had a lower average rate of return. Same scenario. We start out with $1 million. We're taking out 40,000 to start with, and then adjusting that for inflation. So at the end of this time period, 2019, we actually have $943,438, which is, a little over $50,000 less than what we started with a lower average rate of return. And so that shows, go ahead.
So we have lower returns averaged over 20 years, 1.44% lower average annual returns, but we've barely scratched the surface of our starting account value there. Significantly more money, about a $795,000 difference, even with those lower returns. Abby, why is that possible? How does that work?
It's totally counterintuitive. It doesn't seem to make sense to most people. And that's because what's talked about most often is average rate of return. People, advisors, unfortunately, investment companies, they're always touting our fund did, 12% average rate of return over the past 5 years. That's really what's talked about. And so that's like the common language, I would say. And people need a measuring stick to try and make financial decisions. And unfortunately, that's the measuring stick that is being pushed and being used most often, that average rate of return, when really volatility and risk, how much you're potentially going to go down in a certain year, that has as much, if not more, effect on your end result than the average rate of return. So when you have these big losses, even if you're in the accumulation phase, it's not as impactful when you're in the accumulation phase, but it still matters. It still matters when you have those big double-digit downturns. It takes a really long time to come back to those. And so what we try and stress to people is it's not just about shooting for grand slams all the time. It's about those base hits. It's about sticking to fundamentals, making sure that we're protecting and managing the downside. It's much, much easier to come back from a smaller downturn, a smaller loss, than it is to come back from 20, 30, 40, 50% losses. That's difficult to come back from. It takes years and years. And it's sometimes impossible to do when you're taking income. So it's all about the volatility, managing that. What we try and it's difficult. I think one of the most difficult parts of our jobs is to coach people on the changes that need to take place when you're going from the accumulation phase to the preservation and distribution phase. So there's a lot of different changes that need to happen, and they're not really talked about as much. So you can't have the same portfolio at 60 or 65 that you had at 35 or 40. It's just not going to get you the same results, and it's not a fit. And so those changes have to be made.
They understand the challenges that are specific to retirement and how to formulate the plan specifically to address and minimize them. That's why they are the retirement family, been named best of the best in Gwinnett and financial services 8 years and running. And you can get in touch with Abby Reed from the retirement family there at Reed Financial Group by giving a call 678-442-0255, 678-442-0255. You can visit online at theretirementfamily.com, or you can submit your questions. If you've got a concern you would like to hear addressed on a future episode of the program, you can go to goaskabby.com, goaskabby.com, submit your question there. Lots of fantastic resources also available on either of those sites. But the best advice, ladies and gentlemen, is have that plan. Get your custom plan put together for your retirement, and they can help you structure and create and implement that plan there at the Retirement Family Reed Financial Group, 678-442-0255. Abby, thank you for giving us some real world examples on the danger of volatility in our income in retirement.
Absolutely. It was a pleasure. Thanks, Peter.
Here to answer your financial questions, visit the website goaskabby.com for show resources and to submit your questions and get answers, or to schedule your complimentary financial investment and retirement planning strategy session. You can also reach out to Abby directly at 678-442-0255. That's 678-442-0255, or at goaskabby.com.
Investment advisory services offered through Brookstone Capital Management, LLC, BCM, a registered investment advisor. BCM and Reed Financial Group are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. Third-party ratings and recognitions are no guarantee of future investment success and do not ensure that a client or prospective client will experience a higher level of performance or results. These ratings should not be construed as an endorsement of the advisor by any client, nor are they representative of any one client's evaluation.